If you still believe in the 4-year cycle, you have to understand this. The 4-year cycle is breaking, not all at once, but in a way most people won't notice until it's too late. So in this video, I'm going to show you exactly what the 4-year cycle represented. What is it now? What's changing? And what actually drives Bitcoin now, so that you can understand how to best position yourself and navigate Bitcoin. So let's get into it, guys. The 4-year cycle is breaking. So let's start with what the 4-year cycle actually describes, because I really think this is the beginning point. We need to understand it deeply and then work our way towards what drives Bitcoin now and what has changed. So the 4-year cycle wasn't a thing when Bitcoin was created. It was an observed effect over time. Back in 2009 and 2010, when Bitcoin was in its early days, the 4-year cycle wasn't even a thing. The 4-year cycle really started to take hold in about 2017, 2018, when people started seeing the pattern, okay? And the reality with the markets are, guys, is that patterns don't last forever. Edges are exploited. If the 4-year cycle was perfect every single year, people would exploit that edge and eventually it would get eroded. So that is partly what's happened here. So over several cycles, Bitcoin moved through a repeated rhythm. Strong bull market and then a bear market, as we all know. So you can see it by the charts here, okay? So you started in 2010 and then it had a big bull market up here. Okay, then you had a 1-year bear market, then about a 2-year bull market, then a 1-year bear market, 2-year bull market, 1-year bear market. That's the kind of rough rhythm that we see, okay? Bull market peaks often clustered around the same time frames. Bear market lows often clustered around the same time frames. Why did it look so consistent? Well, when viewed on the chart, the repetition looked clean, okay? The structures appeared over and over again. It became easy just to treat the cycle as something Bitcoin inherently obeyed. Humans are created and made to look for patterns, okay? We don't want to look too deep and understand what's going on behind it. We just like simple patterns that help us make decisions, and the 4-year cycle really fit that. People really started to believe that Bitcoin was moving in the way it was because of the 4-year cycle. What did this lead to? Well, the same pattern repeating cycle after cycle led people to believe it was a causal mechanism rather than an observed effect. And after a while, people started using it for deep analysis before asking what actually caused it to move this way, as I said. So it became reinforced, and because as it expanded, the narrative expanded, more people started adopting the framework and began trading around it. And this led to the pattern being even cleaner because people belief shaped it, right? After we have the top, people start believing, oh, we're going to go into the bear market phase and start selling that, okay? Leading to a kind of bear market as we saw. This went unchallenged for so long because the environment produced those outcomes that broadly stayed the same. So the results continue to mirror earlier cycles. So as long as the underlying forces didn't change, the 4-year cycle just appeared to work. But these forces are changing, as I'm telling you now, and Bitcoin is trading in a much different environment than it was before. So why exactly did the pattern work in early Bitcoin? The halving had real weight. This is one of the main reasons. In Bitcoin's early years, changes to supply mattered much more than it does today. Miners are incredibly important back in the day. Nowadays they aren't as important, okay? So you can see by this chart here, early Bitcoin's market cap was about 10 to 50 billion. Now the market cap is about 1.5 to 2 trillion. So that's literally at 100x different. Markets do not trade the same that are 100x different, guys. They trade very, very differently. So scale changes behavior, okay? Liquidity conditions were supportive. Early Bitcoin cycle unfolded in periods where monetary policy and monetary global conditions favored risk-taking. 2010s were insane, guys. Like, interest rates were nearly zero. Everyone was incentivized to buy risk on assets, okay? So interest rates trended lower, liquidity expanded, capital was willing to move into speculative assets. Bitcoin benefited disproportionately. Now, Bitcoin is still going to go up, but it's going to go up for different reasons than what it went up for in 2010s. When the conditions tightened, it corrected sharply. These shifts often lined up enough to look cyclical, reflecting the bear and bull market patterns we've all seen. So reflexivity amplified everything. Now, if you don't know what reflexivity is, it's very, very simple. Essentially, price going up leads to more people believing that the asset's good, leads to more increases in price. That's essentially what reflexivity is. Every single bull market has a reflexive bull market top. Bitcoin goes up, people believe it's better, people buy more, people believe it's better, people buy more. That's essentially what the reflexive loop is. And it happens every single bull market blow off top. When sentiment eventually turns, the same process happens, but in the bear market. Price goes down, people believe it's worse, they sell. Price goes down more, people believe it's worse, they sell, okay? So this is the reflexive loop. A narrow set of drivers. In those early days, Bitcoin was influenced by relatively few sources, okay? We had Bitcoin whales, we had a few small funds, and then we had the miners. Nowadays, we have ETFs, we have institutional interest, okay? With fewer variables at play, repeated alignments between supply changes, liquidity conditions, and investor behavior caused outcomes that looked orderly and repeated in hindsight. The pattern worked because the environment itself was stable and repeatable. It's no longer that way. So the structural changes most people missed. Well, Bitcoin grew up. As I said before, Bitcoin stopped being a small, isolated market and is now something much harder to move. The market cap has expanded by about 100x in the last 10 years or so. Triggers that once produced immediate resources began to have more muted or delayed effects. Scale alone changes how price behaves of an asset. It's not the same market as it was in 2013 or 2017. The new buyer profile changed. Early cycles were dominated by retail flows, miners, and a small number of holders. Today, Bitcoin attracts institutions, we have macro funds, we have longer term allocators, pension funds, governments buying, sovereign wealth funds, okay? These people operate on different time frames. They buy for different reasons. They respond to different signals. And size positions based on their portfolios rather than simple cycle expectations. Liquidity became conditional, okay? So in earlier cycles, liquidity followed a very, very smooth path. And when I say liquidity, I mean global liquidity. Global liquidity is the one factor that's the most important to Bitcoin. Bitcoin is extremely sensitive to global liquidity. A contraction of global liquidity, Bitcoin goes down a lot in expectation of that, I should be very clear. And then a nice expansion of global liquidity, Bitcoin front runs that too and moved violently from it. During the 2010s, the Fed was relatively easy with interest rates. Interest rates were trending lower. Bitcoin was operating in loose monetary conditions, as we would call it, which caused Bitcoin to rally consistently. That is no longer the case. The Fed is being careful about cutting rates, and hopefully they will in the future. But they're being careful, and these are the conditions that we're finding ourselves in now. So Bitcoin has become a macro asset. Like I said, Bitcoin has integrated into the financial system and it's sensitive to macro effects that it just never used to before. Bitcoin didn't used to care about policy that much. The only thing it used to care about is liquidity. Nowadays, it responds very similar to the S&P 500. And it's very, very true. And policy, balance sheets, ETFs, these have all changed the game. So price front runs expectations. Bitcoin is a macro asset, like I just said, and it responds more to expectations rather than fixed events. So shifts in outlook around policy, funding, or stress can move price well before anything actually happens. And like I said, more variables have entered the systems. ETFs, derivatives, global access, you name it. So the danger of four-year cycle thinking. Now, I believe the four-year cycle is changing for the reasons that I'm telling you now. The expectation starts driving behavior if you still believe in the four-year cycle. And this is why I think you have to be careful. So once a four-year cycle believer isn't open to changes in their model, it influences real decisions. If a year is assumed to be a bear market, caution becomes the default, even if the underlying drivers have changed. Exposure is reduced, conviction is lowered, and upside is treated with caution. Even neutral price action gets framed as suspicious and as confirmation as nothing is happening. Patience becomes hesitation, rallies get dismissed, risk becomes asymmetrical, okay? All of this is basically saying is that you could be wrong because the underlying drivers are changing, guys, okay? They're changing. The four-year cycle worked for the reasons I explained. The four-year cycle is changing. So we're going to get to the meat of it now. What actually drives Bitcoin and what should you do? Well, what didn't change? Markets still move in phases. Liquidity expands and contracts. Reflexivity still amplifies moves and causes price to go way above or way below its fair value. Fair value. Positioning and leverage still matters. None of this has changed. What has changed? The timelines are no longer fixed, okay? Drivers no longer synchronize as perfectly as they did. The peaks may appear before or after the 4-year cycle model says. The peaks or the troughs may appear before or after the 4-year cycle says. Conditions over timing. As Bitcoin has grown into a macro asset, it now responds to the environment around it more than it used to. Liquidity, funding, policy expectations, risk appetite shape its outcomes more than whale holders or miners used to in the past, or retail. Retail doesn't really move crypto anymore. So when conditions improve, Bitcoin tends to respond regardless of the year. When they get worse, narratives struggle to hold price. When real yields are high and funding is tight, taking risk is harder and fewer people want exposure. When those pressures ease or expectations shift, risk appetite comes back in and capital starts flowing. And Bitcoin tends to move with that shift. So this is what really drives Bitcoin now. It's a macro asset. The role of the halving today, you might be wondering, well, what's the actual role of the halving? Well, the halving still matters mostly as a narrative and a coordination point, but it's all priced in now. The halving doesn't really matter. We know what the halving is going to be like for the next decades, okay? It's all priced in. The influence is much less than it was before. The replacement model. So instead of watching the 4-year cycle, shift your attention to changes in global liquidity, changes in US domestic policy, the Federal Reserve's plans and their forward guidance, real yield trends, dollar strength, funding stress, and crypto native flows. These variables explain far more of Bitcoin's behavior today than the 4-year cycle model does. And it's more complicated, I get it, guys, but it's accurate. And this is what we're really looking for, okay? We're not looking for simplified models just to make it easier for us. So what should you do? Well, the 4-year cycle hasn't changed. The environment that once made it look reliable changed. Bitcoin still moves in phases. It still pumps high, it still dumps lower. You should understand that a large 80% bear market retracement probably isn't going to happen for Bitcoin anymore, simply because it's more of a stable asset. It has consistent flows coming in. So you should treat it more like the S&P 500. You should just DCA in at good times. If the market crashes because we have a black swan, DCA in. If the market dumps, DCA in. Right now, everything in the macro conditions causes Bitcoin to move upwards. The incentive structure of the financial system causes hard assets like gold, silver, real estate, Bitcoin, and the S&P to move higher over time. You don't have to try and time it. Just buy in when there is good discounts on the market and hold, and you will be fine. Have a lovely day, guys. Bye-bye.